You are listening to The Vocal Technologist. Spoken tech for your ears.
All right, you know that feeling, right? Building something new. It's just relentless. Exhilarating, sure, but also, wow, sometimes tough.
Oh, absolutely. A constant learning curve, especially for founders.
Yeah, exactly. So today, we're kind of cutting through some of the noise, trying to pull out the really useful stuff, the actual wins, and maybe more importantly, the hidden hurdles founders face.
From funding all the way through to like the personal side of things.
Mm-hmm. Let's try and unravel what's really going on out there.
Oh, it's interesting because you see these huge contrasts, like these massive funding announcements, grabbing headlines, big belief, right?
Like, didn't they just raise a ton for AI search?
Exactly. $85 million. They're aiming to power the next wave of AI apps with, better web results, ad-free.
And wasn't there another big one? You.com?
Oh, yeah, huge. $100 million, valuing them at, what, $1.5 billion?
Wow. And they're building for this. Agentic Era, they call it.
Yeah.
What exactly does that mean for people maybe not swimming in AI terms daily?
That's a great question. So the Agentic Era, it's basically a shift. Instead of you telling AI exactly what to do, step by step, these AI agents, well, they act for you, proactively, like a really, really smart personal assistant.
Okay, I see. So you.com is building the foundation for that.
Pretty much. They're handling over 1 billion queries a month, offering APIs,
Mm-hmm.
positioning themselves as that core layer. But, while these numbers are impressive, it kind of begs the question, what's happening behind the curtain for the founders?
Mm-hmm.
Because all this early money, especially through things like safes,
Mm-hmm.
there can be a hidden cost.
Ah, the safeties. Simple agreements for future equity. Designed to be easy, but I've heard they can be, well, a bit of a trap. How does that square with the whole founder gets rich exit story?
It often doesn't, quite frankly. Saves are flexible, yeah, but stack a few rounds, your ownership gets diluted significantly.
How much are we talking?
The data is pretty sobering. Founders often own less than 40% of their company before Series B. Think about it. Maybe 10% gone at pre-seed, another 20% at seed, another 20% at Series A, plus, 12, 13% for the employee option pool.
Wow, that adds up fast.
It really does. So founders need to be strategic. Think about caps. Understand the long-term cost. It takes foresight to protect your slice of the pie.
Which makes that whole idea of how much you actually need after you exit way more important, doesn't it? Because that final number might be smaller than you think.
Exactly. There's that Yale-based exit yield calculator tool people use, helps figure out annual income from a lump sum after taxes and everything.
And the target number people talk about is often around $25 million, right? For real freedom.
Yeah, that's a common figure. But honestly, it's not just hitting the number. Planning for life after the exit identity shifts, finding purpose again, that's just as vital. It's about securing your whole future.
Makes sense. Okay, so beyond the cap table complexities, growth, the lifeblood. And it seems like some old ideas about selling are getting, well, tossed out.
They really are. For so long, we thought purely demographics, right? Small businesses in the UK or whatever.
Yeah, females 1929.
Right. But that can be super limiting. It's much more about who recognizes themselves in our customer stories.
Interesting, like the WP Engine example.
Exactly. Fortune 500 companies were buying their WordPress hosting, which was really designed for small businesses. Why? Because teams inside those big companies had specific, urgent needs. Not a certain size, but a certain problem.
So the real things to look at are like urgency, how open they are to new vendors, who actually makes the buying decision.
And how they measure success. Those are the real dimensions of your market.
That totally reframes how you'd approach sales. And speaking of doing things smarter, AI is obviously huge there too, not just search, but operations.
Oh, definitely. I saw this thing, Leah, an AI agent that basically headhunts engineers 24/7. Companies like Vercel and Ramp are using it.
Wait, how does that work? Is it expensive?
Get this. The company pays nothing up front. Candidates only pay a small success fee if they actually get hired through Leah.
Whoa! That completely flips the recruiting model.
Totally disruptive. And it's not just fancy platforms. Even like your average sales rep can use AI today.
How so?
You could build a cold email scorecard using ChatGPT in like 15 minutes. Feed it prompts about objective, persona, context, instructions, constraints, tone, format. And the SDR can use it to self-assess their emails, improve reply rates. It's about putting smarter tools right in their hands.
Okay, so we've covered money, growth.
Yeah.
But there are always those, let's call them uncomfortable truths in building a company, right?
Always. The stuff people don't put in the shiny blog posts.
Like the open source challenge that seems to come up again and again.
Oh, yeah. The classic. You build something great, give it away. The community loves it. But servers aren't free. Salaries need paying.
And then you try to charge for something?
And suddenly you're a sellout. Even if it's for enterprise features or support, it's this constant tightrope walk between community goodwill and, well, actually running a business. Many learn that lesson the hard way.
Oof. Tricky. And then there's advice. Everyone's got advice for founders. How do you sort the good from the bad?
I love those 3 simple laws for spotting good advice. It's simple, it's boring, and it's constructive.
Simple and boring, huh? Not very exciting.
Exactly. And that's kind of the point. Like gravity, it just works, whether you find it thrilling or not. Good advice isn't about quick hacks or secret formulas.
It's about the basics.
Yeah, showing up, doing the consistent work, calling customers regularly, being disciplined in hiring. Boring stuff that builds something real over time. And it points towards improvement, not just listing problems.
That's a great distinction. Okay, one last crucial one. Your company isn't you.
So important. It's so easy to wrap your entire identity up in your startup.
Yeah, I can see that. Your self-worth tied to the latest numbers.
But you have to maintain that separation. For your own sanity, yes, but also for making clear-headed business decisions. Selling, pivoting, letting someone go. Those things are way harder if your ego is tangled up in it. Objectivity is key.
Wow, okay. We covered a lot today here on what feels like a mini vocal technologist session for founders. From funding ups and downs, that sneaky dilution, to really understanding your market, using AI smartly, and those hard truths about open source and advice.
It's definitely not a straight path, is it?
Not at all. So maybe something for you listening to think about. In this world obsessed with speed and flashy wins, what's one boring but simple piece of advice you could actually commit to this week? Something small, maybe, but consistent. It might just be the thing that leads to those profound long-term results.
Good question to ponder.
Definitely. Think on it, and we'll connect again soon.
Spoken Tech for your ears.